So welcome back. Yesterday we looked at the case study Jamaica, and we started with that one. And as you can see on the slide 107, these are the facts and circumstances. We were required to first prepare the separate financial statement for the two companies and then prepare the consolidated statement of financial position for the group. So you should be in a position for the exam to do such a case study. So please listen carefully and try to understand everything that we are doing. So what we did already, we looked at the separate statements of financial position that is already after the acquisition. So it shows the investment of 450 and the equity of the subsidiary of 300. These numbers are not the same because Jamaica did not buy 100% of Kingston. And they paid a premium, so we will see that this will include goodwill of Kingston, and therefore these numbers, as most of the time in practice, are not the same. All right, so we have the single or the separate financial statements of the two companies, of the parent and of the subsidiary. We will now, or what we did yesterday already, we modified both single financial statements from 1 to 2. So Jamaica, the parent, will continue with the book values. So there will be no change from the single financial statement 1, which is the local financial statements, if they follow the group accounting manual. So in that case, they don't have to change. And let's assume that. Then Kingston had to follow the accounting manual of the group. And in that, they would find that IFRS 3 paragraph 16 says that all assets and liabilities of the acquired company will have to be shown at their fair values at acquisition date. So what we did is we included the hidden reserves, intangibles of 20, in inventory of 10, and then we debited tangibles and inventory, and we credited retained earnings, because those profits were realized with the acquisition. So that, of course, is a pre-acquisition thing, and so it should be in retained earnings. It has nothing to do with the current period. So from the perspective of the purchase, the investor will buy those tangibles at fair value. So the retained earnings are to be credited. All right, so I think that was clear. Now, I think it's your turn again, and please go to Jamaica. No, you go to the breakout rooms and then try to fill out the form, and also put that data into the consolidation table. You will find the form in your scripts. So have fun. Welcome back from the breakout rooms. You looked at the Jamaica case study, and well, we first had to fill in the form on page 111. On page 112, you see my suggested solution, and I think most of you got that right. This is easy, but of course, in a more complex environment, it makes more sense to draw such a picture. So you know the principles how to do that, and you could also do that for a more complex structure, of course. Here it's easy, 80 and 20%. So when we look at the net assets of the subsidiary, we can assume, or we can calculate, that there are net assets of 530 minus liabilities of 200, which is net assets of 330. So there are three possibilities to come to that number. One of you asked me whether you have to do all the three methods in the exam. No, of course not. Just give me one right answer, and that is completely enough. So one of these three is enough. So we can then determine the non-controlling interest, which is net assets times 20%. That's the share of the non-controlling interest. So it's 66. Then we calculate any goodwill. The parent has paid 450 for a 80% of the subsidiary. The fair value of the non-controlling interest is 66. So we have to, because we now will look at the 100% of the net assets, we have to include in the debits here not only the purchase price of the parent, but also the value for the non-controlling interest. So that is 100% of the shareholders, so to speak, which is 450 plus 66, which is 516, I guess. And then we will deduct from that 100% of the net assets, which is 330. So when we do that, we will come to the positive difference. And as it is positive, this is a goodwill. Jamaica obviously has paid more than it got in terms of net assets. And that is called goodwill, because they hope that the company will do a lot of good things in the future and always distribute nice dividends. So that is why they paid that premium. All right, so calculate the retained earnings then. Well, we just go back to the parent's retained earnings. So we look at the single financial statement of the parent, and then add any profit they would get in the post-acquisition period. But as the company was purchased at the very last day in the year, there is no post-acquisition period. So within the year, there is no post-acquisition period, and therefore that the profit for that period is zero, and the share of the shareholders, of Kingston, sorry, the Jamaica shareholders is zero. So 250 plus zero equals the retained earnings of the group at the year end, and that is 250. Okay, so we have done the 5 workings, and now we just put these numbers into the consolidation table, and you will see that it is very easy to come up with the end figures, which is this table here. So we put in the single financial statements number 2, which are the book values of Jamaica and the fair values of Kingston. And then we add those numbers coming up to a subtotal. So we have the subtotal for the group, but the subtotal is just including investment, and there is no investment of the group in a company. So that is the first argument. So we have to get rid of the 450 because those in that investment is related to all the assets of the subsidiary, which we have included already in the group accounts. So we would account for these assets twice. First would be via the investment, and the second is via all the assets and liabilities that are included in all the other numbers here. So that is not correct, of course. We should get rid of the investment, therefore, and we will eliminate that, the 450. So we put a credit over here to eliminate that investment. There will be no investment shown in the consolidated financial statements. Then we will debit goodwill. We will debit ordinary share capital, 200, because we want to get rid of the share capital of the subsidiary, because in the end, we will only show the ordinary share of the parent, which is 100. So by debiting 200 here, we will eliminate the ordinary share capital of the subsidiary. So in the end, we only have the ordinary share capital of the parent. So retained earnings, we just took the 250 to here. So we of course had to eliminate the retained earnings is 130. So 380 minus 130 equals 250. So that's correct. Then we have the non-controlling interest. We put that as a credit onto the balance sheet. And then we will have an equity of 416, because when we add ordinary share capital of the group, of retained earnings of the group, and the non-controlling interest of the group, we come up with the equity of 416. Yeah, then we add the 700 liabilities here, and then we're done. And you should always check whether the totals are the same. In a balance sheet, the total of assets should be the same as total of liabilities plus equity. Okay. So in the end, we will see no investment in the consolidated financial statements. We will see the goodwill, that is the purchase price minus net assets at fair value plus the non-controlling interests. And we only see the share capital of the parent in the consolidated financial statements, and that is correct. Questions? Oops, NCI, yes. NCI is also shown in the consolidated financial statements to reflect the share of the minority shareholders. All right, so any question? There is one question in chat. Excuse me, I still misunderstand why debit of goodwill is 186. Yes, well, let's go back to the calculation. That is here. So when we did the working number 4, which is calculate any goodwill, we looked at what was the fair value of the investment that the parent paid. Well, they paid 450, which is the purchase price for 80% of the shares of the subsidiary. Okay, so I think that is a fact. It was given in the facts and circumstances that Jamaica paid 450 for 80%. Well, then we have to increase that 80% to come up at a value for the whole company. And for that, we will add the non-controlling interest, which we have calculated here. The share of the non-controlling interests was 20%. The net assets is 330. So we have to multiply 330 by 20. So the value of the non-controlling interests, you could also say the minority shareholders equity is 66. So the equity of the majority shareholder is 450, which is what they paid for it. And the value for the non-controlling interest is 66. So now we have the total value, which represents 100% of the shareholders. So the 80% shareholder plus the value for the 20% shareholder. So when we add those two numbers, we have the value for the two groups of shareholders, so to speak. It's 516. When you deduct then what is in the company, when you look at the net assets, well, there are only 330 net assets, which is 100% of the net assets. And the difference between 100% of the shareholders minus 100% of the net assets is 186. So in order for Jamaica to get 80% of that subsidiary, they had to pay a premium of 186. So in other words, they paid 186 more than what would be represented by net assets. Okay. And then we take that number, which is the goodwill, and put it in the consolidated financial statements. How do we do that? Well, in the subtotal, you will not find goodwill in a single financial statements because this is a result of the purchase. So that these are these recording entries here. And therefore, we will debit 186 to goodwill, because goodwill is an asset. It's an intangible asset and will be put on the balance sheet in the assets, on the asset side. Oops. Okay, you got it. Very good, very good. Yeah, I'm glad you asked, because your colleagues might also have that question, but maybe they are too shy and they don't dare to speak up or send a little message to me. So I'm glad you asked me so I could explain it a second time, hopefully with better words, and sometimes that is how it goes. All right, so more questions? No? If not, well, then you are lucky now, because it's shortly before 7. You're done. We will call it a day, and tomorrow morning, let's go back. Let's come back early and do that poll, what we did today. I think we did not do a lot, but I will prepare a poll tomorrow morning. And so please be punctual. I cannot let you in during the poll. So if you're too late, you have to wait. But I think that worked very well this morning, so nobody was late. So thank you very much. Okay, so see you later. See you tomorrow. And tomorrow we are starting early. That means 1:30 your time. Okay, bye-bye. Have a good one.